So the next session is going to be chaired by Mrs. Marina Niforos. Hello, Marina. Marina is the founder and president of the Climate Governance Initiative, the Greek chapter, and she's also an affiliate professor at HEC Paris. Marina is an expert on blockchain and sustainable development. She has held a number of positions in various boards in Greece and abroad. Actually, it's a very long list. I'm just noting the US National Commission for UNESCO, appointed by actually Mrs. Hillary Clinton. She has also worked for the World Bank Group. Marina has graduated from Cornell, and she holds multiple degrees apart from her first degree. She's also holding an MA in Government Administration from the University of Pennsylvania and an MBA from INSEAD. Marina, thank you very much for accepting the invitation. And the floor is yours for the next 1 hour. May I kindly remind to the audience to post their questions for the 15 minutes Q&A, which is going to follow. Thank you very much.
Hello, everyone, and thank you so much, George, for this introduction. It's a pleasure and an honor for me to be here with you today. Thank you for your invitation. As you have seen, for the next hour, we will be collectively and individually trying to address some of the issues that previous speakers have raised and understand a little better what are some of the advances that have been made or can be expected to be made in the near future regarding ESG metrics, data analysis, and some of the fundamental frameworks that seem to be progressing in somewhat different directions until now. To discuss this, we have a very distinguished panel of speakers with us, and it's my privilege to introduce them to you today. We have Linda-Eling, who is the founding director and the head of the MSCI Sustainability Institute. Linda has been with MSCI for quite a number of years, I understand since 2010, and she has really driven the ESG and climate research at MSCI. She held a long career in ESG research even prior to joining MSCI. She has been named twice at Forbes as one of the top 100 women in finance. She's a fellow at the Aspen Leadership Institute, and she holds degrees, a doctorate in organizational behavior from Harvard, as well as a master's degree from the University of Oxford. Linda-Eling, welcome. We'll be hearing very soon from you. Linda will be presenting as to what will be some of the key ESG trends we can expect for 2024. Next, I will move over to introduce Professor Panos Patatoukas. Professor Patatoukas is the chaired Penny Professor of Accounting at the USC Berkeley Haas School of Business. He has a PhD, Master's in Philosophy, MA from Yale, as well as an MSc from the London School of Economics, and he graduated undergraduate from the Athens University of Economics and Business. He has been working at the intersection of capital markets research in a multidisciplinary manner, incorporating accounting, corporate finance, law, and economics. And he has also been a multi-awarded professor, lauded by both MBA and PhD students. He has had prolific research, and today he will be presenting, I believe, a recent article that was co-authored with Professor Skiadopoulos on very aptly named the chicken and the egg problem in the material ESG alpha debate. Welcome, Panos, today. And our third panelist, Lorenzo Sa. So Lorenzo is a Chief Sustainability Officer for Clarity AI, an AI data analytics company. So a very crucial topic. We saw that data transparency, data availability was one of the key challenges signaled out from our stakeholders today. So we're very happy to have you here today to tell us how technology may address some of those problems. So Lorenzo has a long-standing career. Prior to joining Clarity AI, he was with the Principles of Responsible Investment for a number of years, where he drove the growth from 300 institutional investors to over 5,000. He also held actual operational roles in the banking sector with Unicredito and Microrate, and he holds double degrees, MBA, and master's in international public policy from SDA Bocconi, and my own also alma mater, School of Advanced International Studies in Italy. Welcome to all three, and we're looking forward to hearing your perspectives today and contrast what has been said before. So Linda, I will pass the floor to you so that you may address some of these remaining. We heard a lot of optimism, but somewhat contained optimism about some of the progress that's being achieved with incoming regulatory dicta, but also remaining challenges. So the floor is yours.
Okay, let me try to share, and you tell me whether or not it's working. You see? Yeah, okay, great. Well, thank you so much for the opportunity today. I'm really excited to be here to learn from the other presenters and the panelists. And today what I wanted to do is to share a current snapshot of what is the top of mind for the investors that we work with. I'm going to cover 3 trends. First is a focus on refocusing, if you will, on the topic of performance. The institutional investors we work with do not have a naive view that ESG should always outperform, or that there should be always a performance trade-off. I think we're beyond that. We're looking at nuances. Secondly, I want to talk about all things that are net zero. There is a tremendous amount of focus in this area. It is a simple concept, but it's actually quite challenging to define. So measuring and managing that is, sorry, am I still sharing the slides? Yes?
Yes, you are.
Okay. I'm just sharing one example today of the type of advances in analytical tools that investors are adopting. And then finally, I'm going to touch very briefly on the brave new world of private assets, which is becoming a larger and larger blind spot really on the sustainability risks and opportunities in portfolios and on balance sheets. So let me first quickly give an introduction of MSCI. We're best known for being the largest equity index provider in the world, with almost $15 trillion that are benchmarked to MSCI indexes. We're also the largest provider of any type of sustainability data and models and analytics to the global investment industry. Our clients, of course, include some of the very largest financial institutions in the world. And what that means is that we're actually serving a very wide range of investment objectives and approaches. So I often hear this reference of the ESG investor, quote unquote. And to me, that's very much, I think, a mythical figure, because we know firsthand that there's just not one archetypal way to practice sustainable finance. And then our sustainability data cover over 17,000 issuers. Companies are the objects of our analysis on behalf of investors. They're not our client base. So I also often see references to a quote unquote good ESG company. And I'm not always sure what that means either, because we measure company sustainability profiles from many different dimensions, as you can see for the different blocks of types of data sets that we offer. And many of all the dimensions that we're measuring is really based on market demand from investors who choose which of the many thousands of data points actually align best with their particular use case. And so before I dive into the trends, I did want to apologize. I'm going to be skipping through slides that sometimes have a fair bit of data or charts, and given the time constraints, I can't really dive into all of them. But if you're looking for a more analysis, you can visit this website that I put up here for MSCI Sustainability Institute. We launched this institute last year. It is MSCI's think tank for thought leadership collaborations and for sharing our investment grade data and analytics for educating participants in the larger capital markets ecosystem. All right, so diving into the first topic. So in the past year, we've really seen a renewed focus among the investors we work with on how and when and what type of ESG data is actually best used to inform investment decisions and add financial value. As I said, we serve a very wide range of investors. Some are certainly oriented towards aligning their ethical values. Some are intentionally allocating towards a measurable positive impact. I would say, though, that the vast majority of the core fiduciary capital is actually focused on delivering long-term sustainable returns to their beneficiaries or their clients. They may or may not actually label their funds as sustainable or green or ESG or whatever term, but they want to be incorporating information that can capture the changes in the environment and society that can materially impact future risk and performance. So recently, we jointly conducted a survey with Stanford of CIOs and CROs and heads of divisions in large financial institutions. And what was really interesting to us was that despite the politicization that you see here in the US, I'm based here in New York, we saw very little difference actually in terms of how investors perceive and use sustainability factors in investment decision making. So between 2/3 and 3/4 of the respondents see sustainability factors as giving a more holistic view for their investments and also providing some downside protection. Now, just because there's that consensus among large institutional investors doesn't mean that we actually as a field know exactly the right combination of factors to use and when to actually apply them in different market cycles. And so investors often do ask us what academic research is out there, which is investment relevant and practical for them. Of course, I think what's been amazing is that there's been this large and vibrant body of academic research now that are investigating the many different dimensions and outcomes related to sustainable finance. But by far, the questions that are of the greatest interest to investors actually pertain to single materiality and financial relevance. We've gotten so many questions on this that the Institute has started to curate a set of studies so that we can help investors more easily identify the performance-related studies being published. I encourage everyone to take a look and give us some feedback if there are things that you think are missing. I do want to point out that one chronic challenge that investors have confronted in engaging with academic research is having some practical takeaways from academic research because there's been a mismatch in the data that's used by investors and by academicians, and that makes it hard for investors to apply the findings as a practitioner. So the KLD stats data set is just one example, is a legacy data set that's been exclusively used by academics. It has never had an aggregate score, and so different academic studies might aggregate the indicators differently, depending on what their researcher is investigating, and of course that makes sense from that researcher's perspective. But those aggregations are not related to MSCI ESG ratings, and the KLD stats data has never been published for investors, unlike the MSCI ESG ratings, whose underlying data and scores do update frequently for investor use. And so that's kind of one area of bridging the gap that I think would be really helpful. We've seen recently an increased demand for understanding actually the performance characteristics of our ESG ratings. And this is not because MSCI's approach is the only way to be putting together an ESG score. It is because this is the longest running data history in the world of a data set that was designed from the outset to capture only the industry specific set of financially material issues. It is also the closest thing that the investment industry actually has to a market consensus as to what the material sustainability issues are for each industry, which is necessarily dynamic, because on an annual basis, all of our investor clients actually provide input when we reselect which set of ESG issues to weight for each of roughly 150 sub-industries. So the MSCI ESG ratings are used as a market reference, really, against which investors can better understand how their own proprietary scoring and their own proprietary approaches can be calibrated for their own investment strategy. And so over the years, we've tested both the aggregated rating and their disaggregated components, looking at both stock price and fundamental performance. And so at the moment, currently what investors are focused on is drawing lessons from the latest updates, which now has about 11 years of history for the global universe and 17 years of history for the developed market companies. And here's just a quick snapshot of looking at the returns of MSCI's ESG ratings, net of other equity factors that are in the global equity model, which such as size and volatility and quality, which are we've previously shown to be correlated with the ESG rating. And so over the 11-year history, the ESG factor score added 6.5% cumulative returns per unit of factor exposure after controlling for equity style factors. And so, a lot more of this research is actually available through our website. And we certainly always welcome feedback. Now, I want to get back to why we call this focus on performance back to basics. Well, over the past couple of years, I think global institutional investors have had to spend quite a lot of time and effort to make sense of the proliferation of sustainability disclosures and what it means for their investment process and their investment products. I show here really just a snapshot of the main rules in each region. You can see that there's really a lot to deal with, both from a corporate disclosure point of view, as well as from a financial institution disclosure point of view. And you can see that some of the disclosures pertain to single materiality, which are the ones that are marked in red, and others are certainly broader. And we know, of course, in Europe that there's a lot of focus on double materiality related disclosures and definitions. And so we are entering this phase now where investors will be confronting much more sustainability disclosures and where they may be needing to change their approach in light of different definitions in different jurisdictions and different types of fund labeling rules. And so I think my interpretation is certainly that investors' renewed focus on performance is really on understanding which of these factors and which of these approaches to portfolio construction and management could add to or possibly detract from long-term performance. So I want to turn now to the second topic, which is on net zero investing. So in the survey that we had conducted with Stanford, over 90% of respondents indicated that climate is the sustainability issue that will most likely impact their investment performance in a 2 to 5 year window. And only 4% of them think that today's prices actually reflect climate risk. And so, in the area of net zero, MSCI has been regularly publishing the decarbonization trajectory of the world's listed companies. The world's listed companies in aggregate account for about 20% of global GHG emissions. And so in our last updated report, which was published in April, we see that only about 11% of listed companies today currently have an emissions trajectory that would keep it within its own allocated emissions budget, which is sector specific for staying under a 1.5 degree temperature rise by 2100. And currently, we estimate maybe about a third of publicly listed financial sector entities have made some type of decarbonization or net zero commitment. And as these financial institutions monitor the progress that they're making in emissions that they finance, it's not actually particularly easy to be isolating what's actually accounting for the changes that they're seeing in their overall portfolio emissions. And so one very important trend that we're seeing is that investors are demanding new tools to understand all the moving parts of their very complex and diversified portfolios. And so here, what I'm showing is an example of how an investor might break down the emissions change of their portfolio. And I'm sorry if this gets a little bit wonky, but I'm using as an example the MSCI as a sample portfolio, the MSCI ACWI Index. So this is our broadest index that's composed of nearly 9,000 large, mid, and small cap companies in almost 50 developed and emerging markets. And so overall, if you see that the index portfolio's carbon footprint in April 2022 versus 2021 was lower by minus 2.3%. But that's not the end of the story. That's actually just the beginning. The minus 2.3% can be decomposed to exits from the portfolio, which reduced the portfolio emissions by 3.6%, because during this period, Argentina and Russian constituents were deleted from the index. Now, the remaining constituents actually added 0.4% to portfolio emissions, which you then can further decompose into the next layer to the fact that some constituents, such as those in the energy sector, gained a lot of market value during this period, giving them a lot more weight in the index. And you see correspondingly that the emissions intensity actually went down during this period. Now, how do you break that part down? So if you go down one more layer, you can account for the lower emissions intensity by breaking it into attributing to some of the changes to actually lower real world emissions that are associated with those constituents, while most of the reductions in emissions intensity actually comes from the fact that the denominator is changing. So the enterprise value, including cash, the IFFR, which have been increasing during this period. So I don't know if that was too painful of a walkthrough, but this is actually what it takes to isolate the emissions change of the same issuers in a portfolio from one period to another to get to an apples to apples comparison. And so banks and investment institutions know that there are many moving parts in their portfolio that have nothing to do with emissions, but have a lot to do with what actually goes into the calculations of their portfolio level emissions. So it's just one of many areas in which advances in measurements are being adopted by investors and banks and financial institutions as they develop transition plans and strategies. So I think I'm starting to come up to the end of time. Yeah, so I want to just give a quick highlight to private assets. This is growing very rapidly as a significant portion of institutional assets. They account for about 25% of some major asset owners' portfolios. And unlike in listed equities and fixed income portfolios, there's very little transparency on the sustainability risks and opportunities that they carry. So we've had a look at the estimated emissions as well as the disclosures of unlisted issuers within our private capital solutions database, which covers about 20,000 funds. And on the disclosed data, we're able to look at over 50,000 companies that are held in private equity and private credit funds. And we found that currently only about 2% of the companies have disclosed emissions information. That's under 5% by asset value. So I think investors are now very focused on gaining greater transparency into this unlisted space. Earlier this year, we launched a tool to help general partners to collect more sustainability disclosures. This is a very nascent space, but given the growing allocation to private assets, there's a great deal of impetus to be pushing into this frontier. So I'm going to be closing here. My main summaries are investors have a renewed focus on understanding performance. I think academic research in this area could be really beneficial if investors can more directly apply the new knowledge to their day-to-day practice of sustainable investing. Net zero world, it really requires new analytical tools and forward-looking metrics. And so I'm just showing you one tool of the many areas of advancement in this area. And then finally, allocation to private assets continue to grow. Investors demand greater transparency on their exposures to sustainability risks and opportunities. And I think that we're going to see a lot of advancements in this area in the coming years. Thanks.
Thank you very much, Linda-Eling, for this very comprehensive view. And also for bringing the focus on the growth of the private assets and their importance in our discussion today, which was something that for me was new by following the previous discussions. You also opened up the perfect segue to Professor Patatoukas by saying we need important academic research that also has practical insights for practitioners. And with that, I will pass the floor to Professor Patatoukas, who will be presenting us his research. And the question there will be, can we establish a link between ESG score changes and future performance? Is there a way to isolate causation from correlation? The floor is yours.
Marina, thank you very much for the introduction, the very kind introduction. Before we get started, I just want to make sure that you can see my screen and you can hear my voice. Yeah, perfect. Yeah, so, Linda, thank you very much for the wonderful presentation, also for highlighting the MSCI Institute and the possibility for collaborations with academics. I would love to continue this conversation. I will be reaching out to the MSCI Institute. We have many MBA students who are, deeply interested in the MSCI data. Many of them are in finance, but many of them are not in finance. They're running companies and they're trying to integrate sustainability data into their, day-to-day operations. So I would love to continue this conversation. Without any delay, I want to briefly introduce my research with George Kiadopoulos, my friend and colleague from Queen's Mary University and the University of Piraeus, and also Byung An. Byung was my PhD student at Berkeley House a few years ago, 3 years ago. And now he is a senior researcher at Dimensional Fund Advisors. So the title of my presentation material is ESG Alpha, a fundamental based perspective. I think Linda really set up the stage for this discussion because really the question is, and this is something that keeps coming up in, not only in the academic cycles and the professional cycles, but also in the MBA cycles. Students are asking us, can we have, can we use ESG scores and sustainability ratings in ways that can help us build portfolios that beat a benchmark, that deliver performance returns? So the question is, what is the link between changes, variability in ESG scores and future stock performance? Investors, companies, regulators, policymakers, standard setters, data vendors are all mindful of the possibility that sustainability performance can have a material impact on performance. And there has been a need for years now. And I remember the early days of the Sustainability Accounting Standards Board, which was created in San Francisco, right across the bay from Berkeley, with very, very strong Berkeley ties. And the idea at the time was to provide a framework, build a framework that can help investors and insiders, corporate insiders, to identify, separate financially material issues from immaterial issues with respect to ESG performance. The need to identify financial material ESG issues has fostered an ecosystem of standard setting organizations at this point, rating agencies and index providers. And I would say the framework developed by the SASB, the Sustainability Accounting Standards Board, has become kind of the operating system for other frameworks and for many of the data vendors and investors. Now, the SASB has now been folded under the International Sustainability Standards Board, the ISSB, which was created by them. It's part of the IFRS ecosystem. So still, the SASB doesn't exist as a standalone entity, but it was folded under the ISSB. And pretty much the same industry-specific disclosure standards and materiality framework, the template identifying what is financially material and immaterial across different sectors is still powering the ISSB standards. Now, in terms of alpha outperformance relative to a benchmark, there's been research that applies the SASB framework, this materiality framework, to distinguish material issues from immaterial issues across firms operating in different sectors and build portfolios. And the evidence that goes back to a really impactful paper by Khan, Serafim, and Yoon that was published a few years ago in the Accounting Review basically provides evidence that you can overlay the SASB materiality framework on a commercially available ESG scoring system. At the time, it was the MSCI KLD system, which Linda indicated that this is something that academics are using, but it doesn't have much relevance to practice. So they overlay the framework of SASB to this data, and they're able to build a portfolio of firms with improving ratings on material ESG issues, and they show that it outperforms. Now, this paper has had a tremendous impact in practice and the investor community, because this was literally the first evidence to show that one can overlay the template of the SASB, the materiality framework of SASB, with respect to what is financially material sustainability issues, and all of a sudden identify hidden information about future performance that hasn't yet been priced by investors. The argument is very intuitive. The argument is that if you just look at the bottom line ESG score, that bottom line score may be combining information that is material and immaterial, and if you pull all these issues together, basically there isn't a signal that has fundamental value. That signal is being drowned out by noise. So the noise is overpowering the signal if you just pull all items together. Now, the idea of finding alpha in plain sight by overlaying a framework that is as easily accessible as the SASB framework on a commercially available ESG scoring system has been an extremely powerful narrative for the marketing of all kinds of financial products and indices. State Street has launched a factor. It's called the responsibility factor, or the R factor, that basically takes this academic idea and applies this idea in practice by intersecting different data vendors, including MSCI, Sustainalytics, ISS, and others, to build portfolios and indices based on the idea that firms with improving material ESG scores tend to beat the benchmark. State Street responsibility factor in turn has been used or licensed to Bloomberg, and Bloomberg has launched a whole family of indices called the Bloomberg SASB index family that provides basically different styles of investing factors with tilts based on this idea. In terms of the issue that we're trying to address, well, the issue relates to this idea of sorting out causation versus correlation. And already Linda indicated that discussion when it comes to factor exposures, but the idea is very simple, and it's something that is, an issue that confounds pretty much all research in social sciences, that, it's really hard to run control experiments. And in the setting of ESG, it's very possible that companies that have improving performance with respect to ESG characteristics may be very different in terms of their fundamental characteristics, their fundamental profile, compared to other firms that don't have improving ESG performance. So the idea is very simple. The same drivers that could be driving ESG performance may also be driving stock return performance. And empirically, this is something that is not, in our research, we don't have a final answer to how to isolate exogenous source of variation in ESG performance that would empower researchers to perfectly identify the impact of ESG characteristics on portfolio performance. And the reason is that we can't really identify a setting where we can have exogenous source of variation in ESG characteristics that is orthogonal to the fundamental characteristics of the company. So that's really the problem, right? Now, without being able to rule out the issue of correlated or omitted fundamental factors, the endogeneity issue will always confound inferences of alpha or fat performance in this line of work. And this is a feature of the setting, right? And this is the feature of many other settings in finance and accounting. Now, in this paper, what we're trying to do is develop a fundamental-based explanation why prior evidence with respect to outperformance, why this portfolio of firms with improving ESG ratings with respect to material ESG issues only seemingly appears to outperform. Okay, so let me show you the evidence very quickly. So the first thing that we do is we try to identify a fundamental link between changes in ESG characteristics and ESG scores, material ESG scores, and fundamental attributes of the firm. We split the universe, broadly speaking, into more financially established and less financially established firms. And we identify established firms within each sector because those comparisons are more meaningful. Comparing firms across sectors doesn't make much sense. It would also be inconsistent with the SASB framework, which is industry specific. So we basically try to identify leaders and laggards within each particular sector, and we condition this analysis on fundamental characteristics that can be very easily accessed from the financial statements. I'm talking about industry membership, size, growth, profitability. And the reason we try to keep this very, very simple is because those characteristics are known to be correlated with stock performance. And also the cost of accessing this data is extremely low, much lower than the annual subscriptions to any of the data vendors. So the first thing that we do is we try to identify a link between fundamental characteristics and the probability of improvements in ESG scores. And what we find is something very intuitive. What we find is that leaders within each sector are more likely not only to create material strengths in their ESG performance, but also to address material weaknesses. And that's very important because, when things are happening and all of a sudden a company's score is being penalized, those more financially established firms are very quick in terms of allocating resources to address the issue. So those financially established companies are not only more likely to create new strengths, but also address existing weaknesses in their ESG scoring. And the frequency, overall frequency of increasing material ESG scores is almost 2 times higher for more established firms compared to their less established peers within their sector. Another thing that we see in the data, at least in our data, is that the firm fundamentals are leading as opposed to lagging changes in material ESG performance. So in other words, we can anticipate improvements in subsequent ESG scores using fundamental characteristics, but we can't do the reverse exercise, which is interesting. In terms of portfolio performance, a very long line of research in asset pricing identifies fundamental determinants of stock returns, and the evidence is that companies that are more stable and have higher profitability, these are exactly the companies that on average tend to deliver higher returns. But the issue is that these are precisely the same type of companies that are also more likely to better manage their ESG scores, and these are the same companies that are more likely to create material strengths and resolve material weaknesses in their ESG scoring. And the implication of that is that, for an asset manager and investor, every time you try to identify outperformance alpha, you have to keep in mind this potential fundamental link between characteristics, firm attributes, and material ESG performance, because the same fundamental characteristics could be impacting returns for reasons unrelated to the ESG ratings per se. So one of the findings that we have is that, after you better specify the benchmark model for performance, there is no evidence of alpha, at least in our data, against this more comprehensive factor model that accounts for this idea, this very simple idea that companies with ESG, companies that are more likely to improve their ESG characteristics are also companies that have different fundamental attributes. We are sensitive to the idea that research design choices, kind of these baseline findings, can be sensitive to different choices. So that's why in our paper, we also provide evidence with 60 different combinations across different levers in our research design, and we find consistent evidence. Now, Marina, I want to check on the time before I, kind of move forward. How much time we have left?
5 minutes.
Fantastic, guys. Fantastic. So, I'm going to finish a bit earlier, perhaps, but that will give us more time for questions. Now, there's 2 follow-up issues that need to be addressed as, by reference to this baseline result. The first one relates to non-pecuniary utility arguments. The idea is very simple. Even though this portfolio of companies with improving ESG scores may not generate alpha against a better specified model of performance, right? It is entirely possible that investors that have a preference for ESG characteristics may still prefer the materiality portfolio, this portfolio that is based on improving ESG scores, if that portfolio has a kind of an ESG score that is overall better than the benchmark portfolio. So in other words, investors that are ESG motivated may have a preference for a portfolio that has a better ESG rating. So the question is, can we build a kind of a counterfactual portfolio that is entirely based on fundamental characteristics that can deliver not only the same performance in terms of returns, but also be characterized by the same overall level of the ESG score without explicitly conditioning on ESG ratings? So to do this, what we do is we build a portfolio that is entirely based on sector membership and some fundamental accounting attributes like profitability, growth. And what we find is that once we build this fundamental benchmark portfolio that is entirely based on accounting data, financial accounting data, but is not conditioning on ESG scores, when we compare that fundamental portfolio to a portfolio that is based explicitly on material ESG scores, we see that the 2 portfolios are comparable, not only in terms of their performance, but also in terms of their ESG score. And that's very interesting because effectively what we find in our data is we can build a portfolio that is based on fundamental characteristics, that is not conditioning explicitly on ESG attributes, but at the end of the day, it has a similar return profile and a similar ESG scoring profile compared to a portfolio that is explicitly using this data. Now, we call this tracking ability, not only with respect to returns, but also with respect to ESG characteristics. The takeaway here is that if you can build that kind of portfolio, that kind of challenges this idea of hidden information in the ESG scores that are commercially available that hasn't already been priced. Because if I can just condition on easily accessible characteristics that we know are already being priced, then the question is, what is the incremental information that hasn't yet been priced? There is one more test that I'm going to go over, and that relates to external validity tests, which are extremely important, because the way academic research works is our research works in incremental steps. So every time, we try to make a new point, which might be new to the literature, we have to first operate within the existing literature before we try to push forward. So this is a very important test, because what it does, it's acknowledge the issue that Linda raised before, which is the MSCI KLD data is data that has been used by academics, but perhaps are now relevant to the investor community. Now, what we do for this external validity test, we acknowledge this issue, and we try to push forward by working with Bloomberg, SASB, and State Street. And what we do is we obtain the portfolios that are built by State Street, that are powered by the responsibility factor, that is in turn powering the Bloomberg SASB index family. And what's interesting about the responsibility factor is that it's entirely based on this academic research that finds that firms with material ESG scores that are improving are exactly the ones that seemingly outperform. But the difference from our implementation is that, first of all, we're not the ones doing the mapping to materiality issues, so which is good, because there could be biases that we unintentionally introduced in our data selection process, in our matching process. So we overcome this issue because now it's effectively State Street doing that, which may have their own biases, but those biases are orthogonal to whatever issues we may have in our research design. So that's one aspect, but the other aspect is that State Street is actually intersecting information across different data vendors. And I didn't catch the entire conversation that happened in the previous panel, but towards the end of the discussion, I remember somebody mentioned about the inconsistencies across the different rating agencies, or the kind of the relatively weak correlation. The idea behind State Street's implementation using different data vendors is that by intersecting different data vendors, not only you improve coverage, but perhaps you're reducing the potential biases that are specific to each particular data vendor. So anyways, working with State Street and Bloomberg was very interesting to us, because effectively that provides one way to provide external validity test to our design. And what we find is similar evidence that after accounting for the differential fundamental attributes of these portfolios, of these indices, there is no evidence of alpha. What are the implications? Well, a few implications.
You have 1 minute, Panos.
Fantastic. So we'll be right on time. This is not a takedown on ESG research. As a matter of fact, I'm the co-director of the Sustainable Impact Finance Initiative at Berkeley House. We deeply care about sustainability and ESG investing. We're simply raising this issue of omitted correlated variables in the quest for identifying alpha. There's implication about investors. If investors can use a simple portfolio sort based on the fundamental characteristics to mimic the return performance, but also the overall ESG score of the materiality portfolio, then the question is what it is that they're getting incrementally. With respect to the rating agencies, I think there is a lot of room for improvement in terms of building models that can help investors identify hidden information. I think all the rating agencies, understand that, and that's why, they're innovating and they're finding creative ways to introduce alternative data and alternative ways to combine data that can provide unique insights. With respect to the ESG landscape, I feel like there is an opportunity to develop those alternative ESG scoring models. and hopefully empower investors to access decision-useful information that is incrementally relevant with respect to data that they could easily access in cheaper ways from the financial statements. One thing I want to kind of drill down before I close this presentation is that I really feel that, and I think we feel as a co-author team, that there is a need for transparency and accountability with respect to performance and ESG characteristics of portfolios marketed as sustainable relative to properly identified benchmarks. Now, we're not the first to say that. As a matter of fact, the SEC has proposed a whole new set of rules with respect to the disclosure requirements and the names of integration funds and ESG funds. Within the context of those rules, integration funds are funds that consider ESG factors alongside other factors, but those ESG factors are no more significant than the non-ESG factors. Those kind of integration funds will not be able to use ESG in their names because the SEC understands that has been a kind of an area of tremendous greenwashing and investor manipulation. And we think kind of what we do in this paper provides a framework to identify those integration funds in real time. The final thing, and I think for resources that may be on this call and this presentation, is that we feel that also kind of using alpha as a way to evaluate the efficacy of the sustainability standard settings is a little bit kind of misleading. The thing is that alpha is a measure of wealth transfers across different groups of investors. It's not a measure of social welfare creation, right? Using alpha as a way to validate sustainability frameworks like those developed by SASB, we think that can actually lead to distortions. And I think the time is ripe to evaluate the efficacy of the sustainability standard setting process in terms of the real effects on corporate activity, real investments, and transformative innovations that can actually lead to a more sustainable future. Thank you very much, Marina, again for the introduction. Thank you very much for giving the time to explain my research, and I'm looking forward to the rest of the discussion.
Thank you. Thank you very much, Panos, and thank you for introducing what I find quite a provocative proposition about being able to create an optimal alpha-seeking portfolio by focusing on the fundamentals rather than ESG ratings and actually get a better ESG performance, if I can kind of transliterate your main proposition. I'm sure we're going to get a lot of questions because it was quite a complex presentation you did. But I will pass the floor now to Lorenzo. Lorenzo, we heard also from the previous panel at the end, the presentation of the panel, the poll results, which showed that about 55% of the responders found that the most critical issues are those relating to data. So the integrity and reliability of data, and then the verifiability, let's say, of said data. So those were the two components, if I recall correctly. So, we're eager to hear from you. How can technology, and specifically artificial intelligence, provide us with some of that capacity that seems to be missing in restoring trust in the actual analysis and reporting and scoring process? The floor is yours.
Great. Thanks, Marina. And can you hear me?
Yes, we can hear you perfectly.
And the slides are live?
Live.
Excellent. So thanks, Marina and George, and thanks also to Linda and Panos for your earlier presentations. Yes, I'm Lorenzo, so I'm the Chief Sustainability Officer at Clarity AI. And really what the goal I'd like to do, and as Marina was saying, is also touch on a few things that were mentioned in the previous panelists, but really looking at it through the eyes of technology and basically to look at the power of AI a little less as let's call it the Arnold Schwarzenegger and the Terminator film, but more a little bit like the R2-D2 in Star Wars, and how it can be a particularly strong support to the sort of goals that institutional investors are trying to do, and to cover some of the challenges that you mentioned. In a way, I'd like to almost start from the points that Linda mentioned, and the sense that there's quite a number of different drivers that investors are trying to look at when taking on sustainable investing. clearly that element about performance and therefore managing risk and identifying opportunities. So that objective of long-term risk adjustment returns continues to be a very important element. But it's also very clear that other investors are being driven by impact, and everybody is being called upon by the regulatory calls, as mentioned even the previous panel. So there is a sense that there is a need to implement a large amount of sustainability tactics or approaches, and that these require a significant amount of resources with limited amount of time. And in that sense, when the investors or any investors we think will be tackling these issues will probably all go through what would be the knowledge pyramid. And what I mean by the knowledge pyramid is really that pyramid that starts from the bottom on data and really builds on that from data to information to knowledge, wisdom, all the way to action, where that action is really taking that investment decision. And what we believe is technology has now allowed us to have a really good combination to be able to kind of bring scale and bring the sort of level of acceleration and speed, but still accompanied by what we call SMEs, which is really a subject matter expert, basically a sustainability expert that can help develop, guide, and create an AI solution that empowers the institutional investors. So the idea really is, in the next 15 less minutes that I got, is to really walk you through how up this knowledge pyramid AI can actually support. And I'd really like to start from the bottom, which is the issue of data. And I think everyone has pretty much said it there. The issue of coverage and quality continues to persist as being a particular challenge. And this is a recent Bloomberg survey, but I'm sure anyone can have a number of different statistics. Now, where AI can come in is really on two things. The first thing is the actual possibility of coverage. The fact that AI is now able to collect quantitative information, is able to look into tables, graphs, and actually bring in a vast amount of information in a simple way for either AI alone or AI and human together to actually process it. It makes the possibility of coverage significant. I mean, we cover 30,000 companies and more, and it really is that importance to be able to give the data points needed for institutional investors. And actually, to the earlier point that Antonis about the possibility that in certain markets there's less coverage than others, AI can really drive also customizable solution for investors to choose to target region or markets that are not possibility, and to do that at speed and at scale. The other thing about AI, though, is that all this information comes in, but when it's either collected by AI only or AI and humans, and depending on how much of the two things, there still is an issue around the reliability of the data. And in fact, what is important is that with basically AI, there's the ability to run basically reliability models that look at the data set and are able to look at the data point and really looking at a number of different factors. And here there's just three. You can look at data points and say, is this data point really something that we can rely on it, or are there flags that we need to bring in to our sustainability experts to make sure that there's a double or triple check that the data point is correct? And just to give you a sense, we ran a research just recently about 3 service providers that on basically a vast amount of data for these 3 service providers, 13% of the data points were same data points collected from public records were different, and that the value had a divergence of around 20% of the underlying value. So human error in collection is still significant, and being able to leverage on AI to identify that human error is critical in terms of making sure that decisions are taken with accuracy. So this is kind of that element of the data pyramid, the bottom. But as we go up, the reality is that there isn't only raw data. And in fact, there is a number of companies that actually don't report or underreport a subset of important information. I mean, just think of the human rights violations. How many of you have seen much publications of human rights violations? There isn't many, and even when there is, it's only 12% of the largest companies in the world are actually exposing their human rights salient issues. So what can help is now that AI is able to actually take unstructured data and is able to actually convert that unstructured data into structured information for use for institutional investors. And this goes into a wide range of data, starting from additional data the company is publishing, like earning calls, but really a lot is around additional data that sits outside of the published information from companies, which goes from news, satellite, geospatial data, and so on. So that set of data then can now be used by investors in a way that can help accompany the decisions. And one example of those is just how news can help identify controversies. And AI can do this, by basically doing a pretty simple. What we do, for example, is we process 300,000 news every single day. And what we do is through AI, it is able to identify if there is a controversy, categorize it in 39 different controversy types, gives it a severity, and then it actually identifies what's the company that's actually on that. It also can do specific deep dives and specific regulation needs around controversies. But all that going back then is accompanied by, if there's, for example, a big red flag, there still is a subject matter expert that jumps in and accompanies the work that AI and humans to give that to the curated database that we think is going to be helpful. So reported data next to alternative data sets is quite useful, but the reality is there's some information that's just often not out there. And we know that around 42% of Scope 3 companies report on Scope 3. And when we actually deep dive and what that 42 represents, it actually represents on average only 5 or 6 of the categories that actually included into the emissions for Scope 3. So what do we do? Now, the possibility of estimations, which was mentioned earlier, we think is particularly positive. We had an entire session about stewardship. And for example, there is a really good place for estimations to help identify hotspots or companies you want to engage with. But clearly, you need to be cautious of the methodologies. For example, methodologies that, focus on only a sector or geography risk that you invest all in that specific sector and geography. So methodology need to be looked at, assumptions and confidence levels. And the level of confidence that a methodology introduces is quite critical to be on top of. But AI, again, can actually help on this. And in fact, you basically can set, say you have Scope 1 and 2 and you want to define Scope 3, you can set with AI a very high number of features that you want to map a company against to actually identify what is the element that you're missing. And you do that by training the model on a set of information for which you do have reported data, and you have a holdout company to validate that. And then you can provide the outputs, for example, what you see on the right, with a number of different features, which could be, size of the company, number of employees, et cetera. And you can say, are each of those factors contributing to a specific estimate? And do you, the subject matter expert, the specialist, believe that these estimates and for each of these features are correct? And if you as a sustainability expert believe that the model is not well designed, you can remove a feature or augment the role of a feature and retrain the model. And you can do this in a constant iteration so that the combination of human and AI can keep driving the change the values that you're actually looking for. So those are kind of past-looking data. Now, trying to take a step back, where kind of does the investor of the future kind of need? And I think more and more, probably all of you will have said, yes, this is backward information, but what about the future? How can we, for example, ensure that our portfolio is actually, driving the transition of the climate transition and not just decarbonizing on paper? And so that ability to see forward-looking data is important. And then the other thing is, I think, and I was hearing the previous speakers, this image is really imagine if you're a bee and you're told you need to pollinate this entire thing on your own. I kind of sometimes think that's what the investors are told. They need to figure it all out with so many limited resources. And Linda, you were showing all those regulations coming through. And so really, the other really powerful point is that AI is now bringing some tools that are quite exciting. On the forward-looking data, for example, you now can have, once you know the target of, the decarbonizing target of a specific company, you then can go and look through AI at what the transition plans are doing. And specifically, if there is a measurement that tells you how much those actions that companies are doing are contributing and quantifying that contribution towards the decarbonization target. And that if that quantification is not there, you could question the quality of transition plans. And we have a paper that's coming out probably in a week or so that will show that around 40% of the top biggest 400 companies actually don't have that quantification. So a challenge around quality. And then the last thing is really the fact that like ChatGPT has introduced the possibility of developing in-house models that really, we call it our AI assistant, which basically allows you to converse with your portfolio and with your basically your portfolio and your funds, and basically be able to ask and converse like you can do with ChatGPT about what is the performance in the past, about sustainability, what is the transparency of the underlying data. In fact, you can even go look for information through this chat that goes beyond the data points that exist in the tool. You can actually say what is within a specific issue that might be around a sustainability report, but not within the data itself. But importantly, you can go see also the methodology, which goes back to the survey we actually kicked off on earlier, which was the top issue is people want to be able to see what is the underlying methodology. And with AI, you now can actually have that conversation. And in a way, the last thing I wanted to say is that reporting, so that bird and that field, the flowers and the bee, AI now is able to synthesize information in a way that's quite impressive. And so what now it allows us to do, for example, is that you can actually have, just simply by leveraging on the data we already have and the information that an investor might have reported in the past for SFDR, for example, European regulation, you can basically answer a couple of questions in a questionnaire, and automatically it provides more than half of the periodic reporting that SFDR asks for institutional investors. So to wrap up, what we believe and what I think AI really offers is the possibility for investors to climb that pyramid, and to do that along a combination of AI and sustainability expertise. And as you go up, this becomes more advanced and more engaging. But in the top and in the very top, you always have the investor, or the investor that's actually trying to import that portfolio. And for us, that's important because a bit of what we see is that AI really allows the investors to do best what they know and what they should be focusing on, and that the rest can be taken care of by that combination of technology and subject matter expertise. So
thank you very much, Lorenzo. I think we have run out of time, but perhaps I will take one of several questions because it relates very closely to your closing remarks, Lorenzo. So the question is the following. Nowadays, ESG measures are constructed by machine learning methods, i.e. textual analysis of statements, media, etc. Are these measures reliable, or do they capture noise? We have 1 minute.
So the data points, there's different parts to that. So the data points in itself are collected, and so I'm not sure that's noise. That's the underlying data reported by the company. The question that we have a system through which we run the reliability of the data point of the company itself. So if we think that a company is reporting a data point that is unreliable, we don't publish it. But the vast majority of data points are company reported. I think the second level is, okay, on top of that, there's a number of insights that you can run through different methodologies. And that goes from following the SASB report to doing your own SDGs implementation, et cetera. And that is about, in my view, you need to trust whoever you're working with and then be able to always, and this is the important thing of the see-through, you always need to be able to have the ability to see through what is the underlying methodology that is being used. And if you believe that methodology aligns to your values, then I would take a look. In a way, I would almost say that earlier Ananias was saying that, you know, we don't do ratings, we do scores. But if even ratings or scores, you know, I don't think the issue is that there are a compass without the north. I think they're a compass. And then each institutional investor needs to choose their north. And if you know what the methodology underneath is, then you can say, is that my north?
Thank you very much. We have run a little bit out of time, and I'm warned that unfortunately this has to come to a closure. I want to thank all of you and thank our audience that tuned in to participate with us today. Thank you to the organizers for giving us the opportunity and for inviting me today. George, back to you.
Thank you, Marina. And many thanks to all your three distinguished speakers. Unfortunately, we have run out of time, but if any of the speakers wishes to, to make a point, he or she is more than welcome to send us a note, and we will try to address it or share it with the audience somehow.